How to get rid of PMI without refinancing. PMI stands for private mortgage insurance, and nobody likes it. Thankfully, there's a few ways you can cancel your private mortgage insurance without having to do a refi, and we will cover each of those today. If we've never met before, my name is Gavin Sessions with Loans Made Simple. If you're curious to learn about all things related to mortgage and home loans, you are in the right place. Subscribe to our channel. We post new content each week. All right, so it turns out there's 3 ways to cancel your private mortgage insurance, your PMI, without doing a refi. We're going to cover each one of those. And as it turns out, they're all related to LTV, which is loan to value. All right, so number 1 is automatic cancellation. Number 2 is borrower requested cancellation based on the original value. And number 3 is borrower requested cancellation based on the current market value. All right, so before we get into each one in detail, I want to clarify just one thing. PMI, or private mortgage insurance, applies to conventional mortgages through Fannie and Freddie. So if you have an FHA mortgage or you're interested in FHA mortgages, that's a different type of mortgage insurance, but this is still valuable information for you. We'll get into some FHA specifics towards the end. All right, so the first thing we want to mention is the Homeowners Protection Act, and the acronym is HPA, and that's in place to protect the borrower. So the HPA ensures that your PMI is automatically canceled on the date when your unpaid principal balance reaches 78% of the original value, and that's based on the original or the initial amortization schedule. But, and that's a big but, you have to make sure that you are current on all of your payments. So in other words, if you're behind or late on any payment recently, the automatic cancellation will likely not happen. All right, so let's move on to number 2, which is borrower requested cancellation based on the home's original value. So quick note, this option is also provided by the HPA, the Homeowners Protection Act. So let's quickly define what the original value is. It's the lesser of the purchase price or the appraised value at the time the home was purchased. So a quick example of a recent purchase where the buyers negotiated a price of $461,000. The appraisal was ordered and it came back with a value of $484,000. So that's $23,000 of equity for those buyers right at closing. Super cool. But we should go back to our definition of original value. Remember, it's the lesser of the purchase price or the appraised value at the time of purchase. So in this case, the additional $23,000 of equity is great for the buyers, but it doesn't help them get their PMI canceled any sooner. But let's stay on track. So the borrower can contact their servicer on the date that they've paid down their unpaid principal balance to 80% of the home's original value. So again, remember, original value means the lesser of the purchase price or the appraised value. So once they're at the 80% mark, they can contact their servicer to request cancellation of their PMI, but they have to have each of these things in place as well. So the first is they have to be in good standing on their payment history. In other words, no late payments, no missed payments. The second is the borrower actually has to submit an official request for their PMI cancellation. That can be done over the phone with their voice, or it can be done in writing. So the third is the servicer is going to want to confirm that there's been no decline in value, and each servicer is going to have their own rules on how they determine that. They may order an appraisal and charge you for that. They may allow you to do a BPO, which is a broker's price opinion done by a realtor, where a realtor comes out and gives their professional opinion of the home's value. If either of those services are required by your servicer, either an appraisal or a BPO, expect to pay for that as the borrower. And then the fourth criteria that has to be in place is there can be no subordinate liens against your property. So if you've taken out a HELOC or a second mortgage of any kind, that will likely prevent you from being able to get your PMI canceled when you hit that 80% loan to value. All right, so let's move on to the third, which is borrower requested cancellation based on the home's current value. So this option is not provided by the HPA, which is the Homeowners Protection Act, and it does require that your home has appreciated in value. So for this option to be viable, there's a 2-year seasoning requirement, which means 2 years have passed since you purchased your home. So this means if your mortgage is less than 2 years old, it's highly unlikely that your servicer is going to let you out of your mortgage insurance based on the home's current value. Just want to pause the video for a quick moment and invite you to connect with us. If you're ready to take the next step to get qualified and speak to a mortgage professional, a loan officer, or if you'd like to get connected to a great real estate agent, click the links below. All right, so here's some specific guidance if your mortgage is between 2 and 5 years old. So you've hit the 2-year seasoning mark, but you're less than 5 years. So specifically, if your mortgage is between 2 and 5 years old, your new LTV, your current loan to value, in other words, must be 75% or less. So what does that actually mean? Well, let's just get into a quick example. So let's say you recently bought a house for $400,000 and you made a 10% down payment. So 10% of $400,000 is $40,000. If we subtract that $40,000 from $400,000, that gives us an original loan amount of about $360,000. So let's say we're about 2 years into this, which means you probably haven't paid down much of your loan's original principal balance. So Remember, early on in a mortgage, most of your payment goes towards interest, so very little principal comes off in the first couple of years. So based on a $360,000 loan amount and an original purchase price of about $400,000, to be at a 75% LTV, we would need the home to appreciate to a value of about $480,000. And if we assume a 5% conservative appreciation rate, that would take about 4 years. So to quickly recap, you bought a house a couple years ago for $400,000 with a 10% down payment. Remember, most of your payments early on are going towards interest, so the principal balance likely hasn't been reduced all that much, so somewhere in the 350s likely, right? So we would need the home to have appreciated to a value of about $480,000 before you'd be at that 75% loan to value mark. Hopefully that makes sense. So if your mortgage is more than 5 years old, then the loan to value we're looking for is 80%, which is a little bit easier to attain than 75%. So if we go back to that same example, right? $400,000 purchase price, 10% down payment. You've been making payments on your house for at least 5 years at this point. So you've paid down some of your principal balance for sure. Remember that 5% appreciation would have the home worth about $480,000 after 4 years. So long story short, after 5 years, it's very likely that your home's value would have appreciated such that your loan to value based on the current value is 80% or better. All right, so I know we talked earlier in this section about a minimum 2-year seasoning requirement, but there is one example, and that is simply this. If you've made substantial improvements to your home, such that the value has increased not just due to market appreciation, but because of the improvements that you've made, then you can potentially avoid the 2-year seasoning. So here are those specific ways to avoid that 2-year seasoning. So for a Fannie Mae loan, the improvements that you've made to the home must reduce the loan to value to 75% of the current market value. And similarly, on a Freddie Mac loan, the improvements you make to the home must reduce the home's loan to value to 80% or less. Additionally, the borrower must have an acceptable payment history, in other words, no late or missed payments, and a new appraisal will certainly have to be ordered. All right, so the last thing to note here is you must use your own funds to complete those improvements. If you went and got a HELOC or a second loan of some sort or a renovation loan of any type, and that increased your home's principal balance, in other words, you owe more on your house, you would not be eligible to take advantage of canceling your PMI based on the home's current value. So long story short, if you make improvements to your house and or let your mortgage season, in other words, age, the higher the likelihood of getting your PMI canceled. All right, so as promised, here's some quick information on FHA for those of you who have an FHA loan or maybe you're interested in getting an FHA loan. So FHA mortgage insurance is similar to PMI, but it's slightly different, and it's called MIP, which stands for Mortgage Insurance Premium. So based on the current guidelines today, if you take out a new FHA loan today, it's likely that your mortgage insurance will be in place for the life of the loan. In other words, it will not go away until that loan is paid off in full. Now, there is one exception, and that's if you make at least a 10% down payment when you take out that mortgage. In that case, your mortgage insurance would last for 11 years, but there's no opportunity for early cancellation. So FHA MIP for the life of the loan, or for at least 11 years if you make a 10% down payment, is one of the reasons that we try to think of FHA loans as a great get-in loan. In other words, it's a great product to help you be able to purchase the home and get in, but it's probably not your forever loan. All right, hopefully you enjoyed this video. If you'd like to learn more about conventional PMI or FHA MIP, we suggest you watch this video titled, "What is PMI?"